Have you ever wondered why classification or categorization is essential in the world of investment? Imagine you're in a giant supermarket without any signs or sections. It would be chaos, wouldn't it? Now apply that same concept to investment. Without classification, the world of investment would be a maze, hard to navigate and even harder to conquer. Classification simplifies the investment process. It's like a roadmap, guiding you through the dense forest of assets, structures, portfolio management strategies, and more. It's not just about making things easier, though. Classification is a chief tool in risk management. It helps you understand the nature of different investments, their potential risks, and returns. Moreover, it paves the way for alignment with your financial goals. Whether you're investing for retirement, a new home, or your child's education, classification helps you choose the right investment vehicle to reach your destination. So, let's dive into the different categories in the world of investment. First up, we have classification based on asset classes. When it comes to investments, the financial world is divided into three main asset classes. Equities or stocks, bonds or fixed income securities, and cash or cash equivalents. Each class has its own unique characteristics with varying degrees of risk, return, and liquidity. Let's start with equities, also known as stocks. When you buy a stock, you are essentially buying a piece of a company. Stocks are known for their high potential for return, but with that potential comes a higher degree of risk. You see, the value of a stock can fluctuate wildly, and there's always a chance that a company could even go under. Stocks are also highly liquid, meaning they can be bought or sold at a moment's notice. Next, we have bonds or fixed income securities. Bonds are essentially loans that investors make to entities like corporations or governments. In return for this loan, the bond issuer promises to pay back the loan with interest. Bonds generally offer lower returns than stocks, but they also come with less risk. The trade-off? Bonds are not as liquid as stocks, meaning they can be harder to buy or sell quickly. Finally, we come to cash or cash equivalents. This class includes investments like treasury bills, money market funds, and certificates of deposit. These investments are considered the safest of the three asset classes, with the lowest potential for return. However, they're also the most liquid, meaning they can be converted into cash quickly and easily. Each of these asset classes plays a unique role in an investment portfolio. Stocks provide the potential for growth, bonds offer steady income, and cash equivalents act as a safety net. By understanding these classes and their characteristics, investors can create a well-diversified portfolio that aligns with their financial goals and risk tolerance. Understanding asset classes can aid in creating a well-diversified portfolio. Scene script. Next, we have classification based on structure. In the world of investments, structure plays a significant role. The structure of an investment fund in particular can influence how it operates, how it's managed, and how it's bought and sold. The two main structures we'll focus on today are open-end funds and closed-end funds. Let's start with open-end funds. These types of funds are what many people typically think of when they hear the term mutual fund. They do not have a fixed number of shares. Instead, new shares are created as more investors buy into the fund, and shares are retired as investors sell out. This continuous process of buying and selling means the fund is always open for business. Now let's take a look at closed-end funds. Unlike their open-ended counterparts, closed-end funds issue a fixed number of shares at inception, which are then traded on an exchange like stocks. They are closed in the sense that once the initial shares are issued, the fund does not issue new shares or retire existing ones in response to investor demand. One key difference between these two structures lies in how they are bought and sold. Open-end fund shares are bought and sold directly from the fund at the end of the trading day at the net asset value price. On the other hand, closed-end fund shares are bought and sold from other investors on the stock exchange at market price, which can be above or below the net asset value. Another distinction is in their pricing. Open-end funds prices are determined by their net asset value at the close of each trading day. In contrast, closed-end funds prices are influenced by market supply and demand, leading to potential premiums or discounts to the net asset value. Lastly, the management of these funds differs. Open-end funds are actively managed, meaning a fund manager makes decisions about how to allocate the fund's assets. Closed-end funds, however, can be either actively or passively managed. Choosing the right structure can significantly impact your investment strategy. So understanding these differences is vital in making informed decisions about where to put your money. Third, we look at classification based on portfolio management. Here, investments can fall into one of two categories: actively managed funds or passively managed funds. Active management involves a hands-on approach. Fund managers make specific investments with the goal of outperforming an investment benchmark index. They're constantly analyzing market trends, economic data, and company-specific information to adjust the portfolio as needed. This approach can potentially lead to higher returns, but also comes with higher fees and a greater risk of underperforming the market. Passive management, on the other hand, is more of a set-it-and-forget-it strategy. Here, the fund is designed to track a specific benchmark index. It requires less frequent trading, resulting in lower fees. However, the potential for returns is limited to the performance of the tracked index. The choice between active and passive management depends on your investment goals and risk tolerance. Fourth on our list is classification based on investment objectives. Now, when we talk about investment objectives, we're essentially referring to the primary reason you're investing your money. There are three main objectives we're going to look at: growth, income, and safety. Let's start with growth. If your objective is growth, you're essentially looking to increase the value of your initial investment over time. You're not too concerned with receiving an immediate return in the form of dividends or interest. Instead, you're betting on the future of the company or asset you're investing in. Growth investments often include stocks of companies that are expected to grow at an above-average rate compared to other companies. Next, we have income. If your objective is income, you're seeking a regular return on your investment. This could be in the form of dividends from stocks, interest from bonds, or rent from real estate properties. Income investments can provide a steady stream of cash flow and are often favored by those nearing retirement or individuals seeking to supplement their income. Lastly, we have safety. If your objective is safety, you're looking to preserve your initial investment. You're not necessarily looking for a high return, but rather to keep your investment safe from loss. These types of investments often include government bonds, certificates of deposit, or money market accounts. Remember, these objectives aren't mutually exclusive. You can have a portfolio that seeks to balance growth, income, and safety based on your individual needs, financial goals, and risk tolerance. For instance, a younger investor might lean towards growth, accepting higher risk for potentially higher returns, while an older investor might prioritize safety and income. In essence, understanding your investment objective is crucial in guiding your investment decisions. It's like a compass, helping you navigate through the vast sea of investment options. Your investment objective should align with your financial goals and risk tolerance. Finally, we have classification based on specialty. This type of classification zeroes in on specialty funds. These are funds that focus on specific sectors, regions, or ethical considerations, offering a unique lens through which we can view and approach investments. First up, we have sector funds. These are funds that concentrate on a particular industry or sector of the economy. Think technology, healthcare, or energy. Then there are regional funds, which invest primarily in a specific geographical region. This could be a country, a continent, or even an emerging market. Last but not least, we have socially responsible funds. These funds make it a point to invest in companies that align with certain ethical standards or social values. So if you're passionate about environmental sustainability or social justice, these funds may be just the ticket. Specialty funds can add diversity and potentially higher returns to your portfolio. Remember, investing is not just about the numbers, it's about aligning your finances with your values and goals. So, to sum it all up, we've taken a deep dive into the world of investment classifications. We began by understanding the importance of classification in investment, as it helps us make informed decisions and manage risks effectively. We explored classification based on asset classes, highlighting the major types such as equities, bonds, and real estate. We then delved into structure-based classification, shedding light on open-ended and closed-ended structures and their unique characteristics. Moving on, we unpacked portfolio management-based classification, emphasizing how different management styles can impact investment outcomes. We then transitioned to classification based on investment objectives, discussing how these objectives guide investment strategies. Lastly, we touched on specialty-based classification, a category that focuses on niche market segments or unique investment strategies. Remember, the right classification can simplify your investment process and help you achieve your financial goals. Thanks for tuning in.